Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. At point number 1, this summer in parts of the country have been hot. Texas, Florida, record heat. It's been crazy. While other parts of the country, like our home office in Ohio, have not had a hot summer at all, at least in my opinion. It's been rather too cool for my taste. And that's kind of like what's happened in the stock market these last 2 weeks. The rush of a comeback, how hot it was earlier or in certain parts of the market, have stalled a bit in the month of August. We've slowed down quite a bit. Before we get into the S&P, Russell, and NASDAQ numbers, let's track some of the reoccurring weekly numbers we look at. First, we typically look at some stocks that have really moved the markets this last week. How about WeWork? WeWork, which is a commercial real estate company that provides flexible workspace to technology startups and all kinds of other entrepreneurs that need a more flexible workspace than the traditional office lease. Good in concept, horribly managed company. That stock, though, jumped 54%. Now, that's just going from 12 cents a share to 20 cents a share. And the stock is almost certainly in the throes of insolvency, and the meme stock crazies are just trying to make some money on it before it plunders. News Corp, which owns the Wall Street Journal, was the S&P 500 best performer on Friday when it jumped 4.6% for the day. And they reported record profit, which is interesting because it shows that advertising dollars from corporations are still strong. They're still spending money at the WSJ. Finally, UBS, a non-S&P 500 component, was up 5.6% because they told the Swiss government they no longer needed the $10 billion government backstop, which it was granted when it took over the troubled investment bank Credit Suisse, another Swiss investment bank. How about our weekly look at GDP Now from the Atlanta Fed, the best running estimate of real GDP growth based on available economic data for the current measured quarter. There is no forward-looking thought put into this data. It's just real-time data as it's released. No opinions. That's what's going to move this number. Here we go. The estimate for GDP Now, 4.1%, moving up from 3.9% where it landed on August 1st. This week, the data that moved it were releases from the U.S. Census Bureau, the Institute for Supply Management, or ISM, the U.S. Bureau of Economic Analysis, and the U.S. Bureau of Labor Statistics. As you can see, as I mentioned last week, even the stubborn Wall Street economists are being forced to move off of their low pessimism for GDP. How about the initial claims for unemployment insurance, which we use as one of our proxies for the future health of the labor market, hence the future health of the economy? That did spike up this week, although not as to the highs of what we reached in the earlier summer. It came up to 248,000 initial claims for unemployment insurance. And finally, let's look at the markets for the week. The S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was negative 0.31% this week. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 1.59% for the week, the largest loser this week. And finally, the MSCI EAFE, which tracks developed international stocks, that was negative just a fraction, 0.04%, almost squeaking out a gain for the week, but ending the week negative. But that was the lowest loser, the best for the week. Point number 2, this week we got inflation data. The CPI is consumer inflation data, the consumer price index, and the PPI, producer price index, is producer inflation data. Let's look at CPI first, where CPI increased 0.17 month over month. Now, if you analyze that number all by itself, not taking into account what's happened in previous months, that will get you to a 2% target for the Fed inflation rate. However, can they hold that number? That's the key. This is right in line with where it came in last month when it hit 0.18. Now, your news media sites are telling you 20 basis points because they round that up, but we get to the nitty gritty as you can see on your screen. Using the previous 12 months inflation data, as you can see again on your screen, we're sitting at 3.2% annual inflation currently, and this is slightly higher than the 3% number we saw when we were using June's data as the most recent 12-month data. The core inflation number, which the Federal Reserve looks at more closely because it excludes the volatile food and energy numbers, also increased 20 basis points, 0.2% for the month. So good numbers in regards to CPI, and the markets like those numbers. However, to add to your confusion, the PPI numbers, or Producer Price Index, came out on Friday of this week, and those numbers ticked up. They went up to 0.3%, which, as you can see, is the highest level since the early part of 2023 when we hit 0.43% in January's number, which was reported in February. The main increases for PPI, which are simplistically what businesses are paying for goods and services, but the uptick for businesses was on the services side, not the goods side, but the services side of the sector. And 40% of that increase was tied to prices for portfolio management. Suffice to say that businesses having portfolio management done for them, investing money, are seeing a decent increases in their prices that they pay. This is a good time to remind our clients that Whitaker-Myers Wealth Managers has never levied a price increase on our clients. As our motto goes, we do better when you do better. So our price increases come when we do a good job, the way it should be. We should be rewarded that way. To wrap this up, PPI numbers are seen as a leading indicator for CPI. So let's watch CPI next month, because the higher PPI, not good news, but we'll have to wait and see. Point number 3. This week, the U.S. Index of Consumer Sentiment was released. Remember, this survey provided by the University of Michigan, tracks consumer sentiment in the U.S. based on surveys of random samples of U.S. households. The index aids in measuring consumer sentiments in personal finances and business conditions, among other topics that they look at. Historically, the index displays pessimism in consumers' confidence during recessionary periods and increased consumer confidence in expansionary periods. Consumer sentiment is very important because consumers are 2/3 of our economy. If they're not happy, they're not spending money, and the economy is not moving forward at a rate it could be. This month it came in at 71.2, which was below the 71.6 reading in July. It's still 42% above its all-time high, or all-time low, 42% above its all-time low, and moving towards its long-term average of 86. This reading mainly ticked down because of higher gas prices that led consumers to be less optimistic. And point number 4, let's bust another myth. That myth is this week, credit card balances hit $1 trillion. That's not a myth. That actually happened. But here's the myth. A flashy number, $1 trillion, and one that anyone that's trying to sell you gold, annuities, or any variation of whole life or universal life, or as I call them, whole lie insurance, however, they're going to use this to convince you to not invest in the U.S. economy or U.S. stocks, because this $1 trillion of credit card debt is going to kill us. Well, here we are with data to rescue you and dissect their horrible sales tactics. Before the pandemic, from 2013 to 2019, the compound annual growth rate of credit card balances was 4.68%. That's how much we grew our balances each year. Does anyone want to guess what the growth rate from 2022 to now is? It's also 4.8%. Woo! So to simplify it, we are right where history says we should be. Yes, as you can see on your screen, the growth rate has accelerated in 2020 and 2021, but that's because the government gave massive amounts of stimulus, which people used to pay down their credit card balances, only to spend them again once they found something they wanted to buy. So this is just part of the long-term trend you would expect to see with an economy that is growing its population and inflation is moving the cost of everything up. Credit card balances should rise. And again, we just showed you what the annual compound growth rate is, and we're right in line with that annual compound growth rate. So don't let anyone tell you this is a reason to be bearish on the U.S. economy. Frankly, it's more of a reason to be bullish. People are spending money and not at unsustainable clips because we're right at the annual normal growth rate. Now, let's remind you very quickly, we don't advocate nor endorse the use of credit cards, okay? It's an economic point. I'm not saying get a credit card. Please don't put that in my mouth. As you know, we believe that debt-free life is a simple life and a risk-free life. As Dave Ramsey says, his advice is outside of the norm, being that normal in America is a student loan around so long it's like a pet, and having Capital One take everything in your wallet. What's in your wallet with Capital One's in there? Not money, okay? So not an advocate, but it is economic data. It came out this week. It was an interesting point. And something, again, it's not worrying us. Numbers get bigger as the economy gets bigger, as your population grows, and as inflation moves numbers forward. Okay? So you can't let a single data point reflective of looking at the big picture inform your decisions. Although the gold guys and gals would love you to make that decision. But we're here to save you from them. We're here to save you from the whole life insurance liars and the universal life. Come bank on yourself or be the bank or do what the wealthy do. Trust me, if the wealthy do that, there's a rationale for it. And it's not the way they grew their wealth. I promise you it's not how they got to that wealth. There are reasons why they do it, but it's not why they got to that wealth. Why they got to that wealth, investing in a small business, running a small business that became a large business, investing in the U.S. economy or another economy that grew, doing the things you're trying to do with your 401k, your Roth IRA, the things that are tried and true to get you wealthy. I promise you, I've never met anyone that said, you know how I got my million? Whole life insurance, universal life insurance. I'll tell you what, there's been a lot of millionaires made by the people selling that stuff. A lot of millionaires. Big commissions. Ooh, lots of green when they do that kind of stuff, but it's not going to get you wealthy, okay? So stick with Dave. Stick with Dave's principles. Stick with any good financial planner that can do basic math. They'll make sure you stay on the straight and narrow, which is a great point to say, hey, if you would like to schedule a meeting with any of our financial coaches, you can go to the comment section of this video. You can click on the link. The link will take you to our scheduling software where you can schedule a meeting with Lindsay Curry, one of our financial coaches, and she can help you get out of debt, stay out of debt, live on a budget, hold you accountable to that budget, or help you save on the cost of college. Not necessarily save for college, but the cost on college with our college debt-free program that she can run you and your kids through. As well as if you would like to schedule a meeting with our financial planners who help you in baby steps 4, 5, and 6. Get out of, oh, actually, no, you're already out of debt if you're in 4. You are saving 15% of your income towards retirement. You are saving for your kids' college. Now you're saving for college. And now you are working on paying off your house. Or maybe you have your house paid off and you're living and giving like no one else, which is the #1 reason why we do this. Because we try to get people and graduate people to baby step 7, which is a wonderful feeling. The grass feels so different when you're at baby step 7. Hey, would you do us a favor? Hit the like button on this video. Hitting the like button tricks Google and YouTube's algorithms. They don't like us because we're conservative and we're Christian. So if you hit that like button, that helps us get higher on their algorithms and gets our content out to more people, as well as hitting the subscribe button. And the subscribe button helps you get our content first. Thanks so much. We'll look forward to seeing you next week on what we learned in the markets this week.